There's a number being thrown around in every bearish XRP take on the internet right now, and almost nobody is challenging it correctly. The number is 61.3 billion. That is the headline circulating supply of XRP. Bears use it to argue that there is too much float for the asset to ever reprice meaningfully. Bulls counter with vague references to escrow, and hodlers without ever doing the actual arithmetic. And in that gap between sloppy bearish framing and sloppy bullish counter framing, the most important supply analysis of the entire cycle is going completely unexamined. The number one mistake retail investors make when looking at this asset is treating circulating supply and effective liquid float as if they were the same thing. They are not the same thing. They are not even approximately the same thing. And once you understand the difference between the headline 61.3 billion and the actual fraction of that supply available for purchase at current market prices, the entire conversation about price potential changes. Not because of hype, not because of optimism, but because of arithmetic. What I'm about to walk you through is not being explained on the news. It is not being explained on the major XRP channels, and it is being completely buried under daily price commentary. Let me pull back the curtain on what a supply shock actually is in the technical sense, why Raoul Pal's Great Reset framework is not a slogan but a precise structural description, and why the on-chain data is now confirming, quarter by quarter, that the effective liquid float of XRP is a tiny fraction of what almost every bearish argument assumes. The world is missing the math again. We are going to fix that today. Welcome back. I am the Calm Analyst, and on this channel, we do not chase pump dates. We do not promise Lambos, and we do not sell you fantasy. We decode infrastructure. We read the filings. We follow the math. Today we examine 4 supply reduction mechanisms that operate simultaneously on this asset, calculate what they collectively mean for the actual tradable float, and then translate that float against documented institutional demand to show why the word reset, used carefully, describes what happens when constrained supply meets fiduciary mandated demand. Sit back. Let's get to work. Let's start with the hard truth. About 95% of the people debating XRP supply have never properly distinguished between 2 completely different concepts that sound the same but are not the same. The first concept is circulating supply, which is the headline number you see on every tracking website. The second concept is effective liquid float, which is the portion of that circulating supply actually available for purchase or sale at current market prices, right now today, by an institutional buyer trying to build a position. Confusing these 2 numbers is the single most common analytical error in this asset class. And that confusion is precisely what allows bearish takes to anchor on the 61.3 billion figure and pretend it represents the relevant denominator for any pricing analysis. To understand why this distinction matters, you need to understand what a supply shock actually is in the technical sense, not the social media hype sense. A shortage is when demand exceeds available production capacity. A supply shock, in the context of a digital asset, is something different. It is the condition where the effective liquid supply, the portion of the total that is genuinely available at current prices, falls below the threshold required to absorb the demand building in the system. When that threshold gets crossed, the price does not just rise. It reprices. And the difference between a price rise and a repricing is the difference that almost nobody in retail crypto explains correctly. A price rise happens when demand grows incrementally against a supply that adjusts gradually to meet it. Think of a normal bull market. Demand picks up, sellers raise their offers, The price walks up the order book in an orderly way. Buyers and sellers find each other at slightly higher prices each day. That is a rally. It is reversible. When demand fades, the price softens. A repricing is fundamentally different. A repricing happens when the supply that was providing the price floor is suddenly insufficient to meet the demand, and the market has to find an entirely new price level where the available supply can clear the buying pressure. That process is fast. It is asymmetric, and critically, it does not reverse, because the supply that just got absorbed into institutional custody, operational reserves, or long-term institutional positions does not return to the market when the price moves. It is gone from the float. The new equilibrium replaces the old one. That is what the word reset describes. Not a rally. A structural step change. The crowd is asking, when does XRP pump? The calm analyst is asking, what is the actual effective liquid float of this asset? And what happens when fiduciary mandated institutional demand hits it? Those are not the same question, and only one of them survives the math. Now let's walk through the 4 supply reduction mechanisms that operate simultaneously on XRP, because the aggregate picture is more significant than any single mechanism in isolation. The first mechanism is the Ripple escrow. Ripple holds approximately 20 billion XRP, about 34% of the total circulating supply, in a structured escrow that releases 1 billion tokens per month on a programmatic schedule. The bearish takes love to cite that 1 billion figure as if it were dropping onto the open market every month. It is not. Of each billion released, Ripple historically relocks between 700 million and 900 million in a new escrow tranche. The net monthly release into circulating supply ranges from approximately 100 to 300 million tokens. At current prices, that is roughly $140 to $420 million of monthly net supply addition. And here is the part the bears refuse to engage with. The ETF inflows since January have been running at roughly $483 million per month. The ETF complex is absorbing the entire net escrow release and then continuing to absorb additional supply from the open market. The escrow is not a pressure on the float. It is being neutralized by institutional demand on a monthly basis. The second mechanism is long-term holder dormancy, which the on-chain HODL wave analysis documents precisely. HODL wave analysis tracks the age of XRP in circulation by measuring how long each token has been since its last movement. When a high percentage of supply has been stationary for an extended period, it indicates that those holders are not responsive to near-term price changes. They are holding through cycles. The XRP HODL wave data shows that an increasing percentage of the circulating supply has not moved in over 12 months. And that percentage has been growing throughout the regulatory uncertainty period, exactly when the bearish takes were predicting capitulation. The rational interpretation of that data is straightforward. Holders of the stationary supply have either a cost basis or a thesis that does not motivate them to sell at current prices. They are waiting for a specific price level or a specific structural event before they consider exiting. Their supply is functionally unavailable to the market at current prices. Conservatively, this represents around 40% of the non-escrow circulating supply, meaningful billions of XRP that simply will not transact at anything close to today's range. The third mechanism is institutional custody absorption, documented through the ETF filing data, the Grayscale Trust data, and the institutional prime brokerage flow. When XRP moves into an ETF structure, a Grayscale Trust, or an institutional custody account, it is removed from the liquid trading float and placed in a custody arrangement that is structurally not oriented toward short-term selling. ETFs create and redeem shares based on institutional investor demand, but they do not systematically sell the underlying XRP except in redemption scenarios. The net effect of the ETF complex on supply is that of a continuous mechanical buyer that converts liquid trading supply into custodied institutional holdings. Since the XRP ETF ecosystem launched, billions of dollars of XRP have been absorbed through this mechanism. That absorbed supply does not return to the float when price moves against the ETF's net asset value. It returns only when institutional investors redeem ETF shares, which happens at a fraction of the rate of retail trading turnover. The fourth mechanism is the on-demand liquidity operational reserve. When a financial institution deploys Ripple's ODL product for cross-border settlement, it maintains an operational reserve of XRP in its liquidity pool. That reserve is not part of the trading float. It is operational inventory the institution holds to execute settlement transactions. As ODL deployment scales across more corridors and more institutional partners, the aggregate operational reserve held across the network grows. Each new deployment removes a portion of liquid trading float and converts it into operational reserve that is not available for speculative trading. Ripple reports this growth quarterly. Each growth data point is, mechanically, a supply reduction data point. Now let's put the four mechanisms together, because the aggregate picture is what makes the math click. Total circulating supply is 61.3 billion. Of that, roughly 20 billion sits in Ripple's escrow. Approximately 16 billion plus is in long-term holder dormancy based on HODL wave data. Institutional custody, through ETFs and trust vehicles, accounts for additional billions. Ripple's ODL operational reserves remove several hundred million more. When you stack those mechanisms and run the arithmetic conservatively, the effective liquid trading float, the XRP that is actually available for purchase or sale at current market prices, is on the order of 10 to 15% of the headline supply number. That is roughly 6 to 9 billion XRP. At current prices, that is a market value in the single-digit billions of dollars. Stop and let that sink in. The relevant denominator for any honest demand versus supply analysis is not 61.3 billion. It is closer to 6 to 9 billion. The headline number that the bears anchor on overstates the actual tradable float by roughly an order of magnitude. Now I want to bring in Raoul Pal's framework because this is where the supply analysis connects to the broader monetary thesis in a way that gives the word reset its full structural meaning. Raoul Pal does not throw the word reset around lightly. His analytical career has been built on identifying regime changes that most people only see in hindsight. When he uses the word in the context of an asset's price behavior, he's not predicting a number. He's describing the condition where the relationship between supply and demand becomes so structurally imbalanced that the price cannot maintain its current level, regardless of what sentiment, chart patterns, or short-term market dynamics suggest. The reset is the moment the math takes over from the market. His application of the reset framework to XRP rests on two observations stacked on top of each other. The first is the supply shock mechanics we just walked through. The four simultaneous supply reduction mechanisms that have collapsed the effective float to a fraction of headline supply. The second is the demand surge from his great monetary transition thesis. The institutional shift from legacy correspondent banking infrastructure toward blockchain-based settlement, which generates demand for XRP that is structurally different from retail speculative demand because it is driven by operational necessity, not speculative intent. When you combine those two observations, constrained float on one side, fiduciary and operational demand on the other, the mathematical output is not a rally. It is a reset. The distinction matters because a rally reverts. A reset does not. After a reset, the prior price does not return because the conditions that supported it do not return. The supply that was liquid before the reset is now custodied, operational, or absorbed into institutional reserves that do not come back to the float regardless of price. The demand that was speculative before the reset is now partially operational and fiduciary, which means it does not retreat the way speculative demand retreats. Ask yourself a brutal question. What happens when an institutional buyer operating under a fiduciary mandate, a buyer whose allocation committee has already approved the position, whose compliance team has already cleared the trade, whose execution desk has been instructed to deploy a specific dollar amount into XRP, encounters an order book where the available supply at current prices is a small fraction of the size required to fill that order? The answer is the same answer it has always been in financial history. The institutional buyer pays whatever the market requires. They do not abandon the trade. They do not negotiate. They walk the order book up until the position is filled. That is what price-insensitive demand against constrained supply produces. That is the mechanism, that is the reset. This is calculated positioning, not gambling. While retail investors stare at the spot chart waiting for a green candle, the institutional layer has been quietly building positions sized and structured for a regime change rather than a rally. Goldman Sachs's disclosed XRP exposure is sized as a regime change position, not a trade. Bank of America's decade-long Ripple-related patent portfolio is the most unambiguous evidence of regime change positioning that exists. Patent portfolios are not built to capture rallies. They are built for competitive positioning in a market structure that the patents are designed to define and defend. Morgan Stanley opening XRP exposure to its wealth management advisor network, providing access to a client base measured in trillions of dollars of total wealth, is retail distribution infrastructure built for a structural theme, not a price move. These are not coincidences. These are independent institutional decisions converging on the same thesis. The price is the lagging indicator. The infrastructure positioning is the leading one. We are watching the structure get built. The candle will follow eventually. Now, let me be honest about how the math actually translates to price, because this is where the bullish takes get reckless and the bearish takes get lazy. I'm not going to give you a single magic price target with absolute confidence. Anyone who does that is selling you something. What I will give you is the analytical framework so you can understand why the price bands discussed across the institutional analyst community are wider than retail investors typically realize. If the effective liquid float is in the range of 6 to 9 billion XRP, and the institutional demand wave that arrives once the regulatory triggers fire is measured in tens of billions of dollars, then the price at which the available float clears that demand is not determined by the seller's prior expectations. It is determined by the buyer's necessity. The market finds the level. That level becomes the new equilibrium. Different demand assumptions and different float assumptions produce different equilibrium estimates, which is why you see analyst targets ranging from the high single digits to low double digits for the near-term reset zone, with longer horizon targets stretching meaningfully higher as additional demand layers. Sovereign integrations, the agentic economy, real-world asset tokenization compound on top. Notice what I did, not just do. I did not give you a single number with absolute certainty. I did not promise you a specific multiplier on your bag. I gave you the framework, the inputs, and the band, because that is what real analysis looks like. The reset thesis does not stand or fall on hitting a specific decimal. It stands or falls on whether the supply mechanics and the demand mechanics actually converge the way the data suggests. Right now, the on-chain data and the institutional filing data are both moving in the same direction, quarter over quarter, with no sign of reversal. This isn't a prediction, it's a requirement of the math. If you have constrained float, growing dormancy, expanding institutional custody, growing operational reserves, and an approaching demand wave from regulatory unlock plus ETF flow plus operational adoption, the unit price has to expand to absorb that demand without breaking the order book. That is not opinion. That is the operational physics of how settlement assets behave. If you have a problem with these numbers, you do not have a problem with me. You have a problem with the laws of finance. Now, I want you to think about what this means for accumulation, because this is where the practical implication actually lives. We are moving from an era of XRP abundance to an era of XRP scarcity. And most people will not realize the transition has happened until it is already over. Here is what nobody wants to say out loud. The window for accumulating whole tokens at current prices is structurally a function of how long the regulatory triggers take to fire relative to the rate at which the four supply reduction mechanisms are draining the float. Every month that passes, the Ripple net escrow release gets absorbed by ETF flow. Every month, more supply migrates into long-term dormancy. Every month, more institutional custody positions lock additional billions out of the trading float. Every month, more ODL operational reserves come online. The float keeps shrinking. The institutional pipeline keeps loading. And the spot price keeps doing what spot prices always do during these phases. Chopping sideways, frustrating retail conviction, shaking out the impatient. The window for accumulating at current prices does not close on a specific date that I can give you. It closes when one of two things happens. Either the regulatory triggers fire and the demand wave hits the constrained float faster than the order book can absorb at current levels, or the supply absorption from the four mechanisms simply outpaces the float that is willing to sell. Whichever happens first ends the window. The institutions, the central banks, the sovereign treasuries, the systemically important banks, they have spent years quietly preparing. They have done the legal work. They have built the custody relationships. They have written the model portfolio allocations. The retail crowd has spent those same years getting shaken out by chop, by FUD, by sideways months that feel like they will never end. That is not a coincidence. That is how every major asset reclassification in modern financial history has played out. The patient holders who understood the structural story end up on the right side of the revaluation. The impatient holders who treated this as a trade end up as the exit liquidity that funds the entry of the informed. I know it is hard to hold conviction when the price chart does not yet reflect the supply analysis. I know the headline, 61.3 billion supply number, gets thrown in your face every time you mention this thesis. As an analyst, I am trained to distinguish between noise and signal, and I want to be honest with you about something. The current price is not the asset's verdict. The current price is the residual reading of a market that has not yet incorporated the float compression into its valuation models. The four supply reduction mechanisms are real, documented, and ongoing. The institutional demand wave is real, documented, and approaching. The gap between those two realities and the current spot price is the asymmetry. That is what real analysis looks like. Anything that promises you a precise price target with no error bars and a precise date with no conditional dependencies is not analysis. It is content. Being early feels exactly like being wrong, right up until the moment reality catches up. The boredom you feel right now, the chop, the headlines that say nothing is happening. That is the calm before the systemic reset, not evidence against it. Financial systems rarely scream before they move. They whisper. And right now, the whispers from the on-chain data are getting noticeably louder. I cannot tell you what 1000 XRP will be worth in 5 years. No honest analyst can. What I can tell you is that the 4 supply reduction mechanisms are operating simultaneously. The effective liquid float is a fraction of the headline number. The institutional demand wave is loaded and approaching, and the gap between speculative tier valuation and settlement tier valuation is exactly where the holders who paid attention get rewarded. Stack what you can responsibly afford. Plan around your real life, not around a fantasy. Do not borrow against an analyst's target. And distinguish between the noise of the day and the signal of the structure. Let me close with a single thought. The crowd is debating the headline, 61.3 billion supply number. The calm analyst is watching the moment 4 simultaneous supply reduction mechanisms collapse the effective float to a fraction of that number, while a documented, fiduciary mandated, institutional demand wave loads in the background. One of those views fits in a tweet. The other one fits inside the structural mathematics of how this asset gets repriced. Headline supply is a distraction. Effective float is the reality. One is a number on a tracker. The other is the math underneath the market. History does not reward comfort. It rewards the people who paid attention while the room was loud about the wrong number. If you made it to the end of this analysis, drop the word float in the comments. I want to see who actually understood what just got broken down today, because that is the audience I'm building this channel for. If this is the kind of breakdown you want more of, the kind that does the actual arithmetic instead of repeating headline numbers, you know what to do with the subscribe button. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient. Stay rational. The math doesn't lie, and the system is almost complete. I am the calm analyst. I'll see you in the next briefing.